Hello, my name is Steve Janz and welcome to my YouTube series for Intermediate Financial Accounting 2, also known as FA3. What we're going to do is we're going to take a look at Happy Corporation. We're going to look at a share retirement question. I'm going to solve the entire question for you, walk you through how to solve each of the journal entries. There's a couple little tricky areas, and I want to make sure you understand the logic behind how we do these journal entries so that on the next quiz or the final, you will get 100%. Let's get started. What's really key is reading this question initially and looking at the opening balances. There's an opening balance for contributed surplus. In this topic, we have to know what that contributed surplus balance is attributable for. Was it a preferred share transaction historically, or was it a common share transaction historically? And looking at the question, it was a previous cancellation of common shares. So if we see anything related to common shares, we have to keep that balance in the back of our mind, and we may have to use it. We also see that the common shares have an opening balance of $399,950, and that the average cost of those shares was $95. We're going to need that information later on in the question. Let's get started. The first few entries, pretty straightforward. They all relate to the preferred shares. So we sold some preferred shares, and then entries 2 and 3, we repurchased them. So let's walk through how to do that, get an understanding how to do the basic retained earnings and the contributed surplus related to those entries. So right off the bat, here's our first entry. Cash, because we sold the preferred shares, we sold $15,200 times $110 per share. That is equal to $1,672,000. So that's how much cash we will receive, $1,672,000. And then we credit our preferred shares. Now, we retire some of these preferred shares at a later date. We retire 3,000 of these. We repurchase and cancel them. And we pay $100 per share. Now, we sold these shares initially for $110, and we're retiring them for $100. So in a sense, we're doing well. We're basically buying them back $10 cheaper. So that turns out to be a nice thing for the company in some ways, in the sense that we sold something at a higher price, bought it back at a lower price. Now the challenge we have is that we can't put that through the income statement. That would affect the operations, and that would affect and possibly skew the results of our normal operations. That's what the income statement's about. And if you think about it, the income statement's about reporting normal operations. This isn't normal. This is financing. So we don't want to put this through the income statement. So we've made some money doing this. What do? Well, we put this through in our equity section, and we create an account called contributed surplus. So we don't run it through the income statement. We keep everything in the balance sheet. We call it contributed surplus for any types of gains. So let's take a look at this entry. We're retiring our preferred shares, and we basically retired them at the price that we basically issued them. So we issued them for $110. So that will be equal to $330,000. So $330,000 for our preferred shares. Now we paid $100 for these preferred shares. So we paid cash-wise $300,000. So cash, $300,000. So what is this difference? Well, this difference is that gain I was talking about. And we can't put that gain in the income statement. The income statement's designed for our operations, our sales minus cost of goods sold for most companies. This is financing. So we keep that gain in our balance sheet, in the equity section, and we create a special account called contributed surplus. And it's very important that we label it preferred, because we want to make sure we keep separate accounts for contributed surplus attributable to common shares and contributed surplus attributable to preferred shares. We have to separate those two. Now, our third entry, we repurchased and canceled another 3,000 shares and another 3,000 preferred shares, but this time we paid more than we issued them. This time we paid $124. So how much cash did we give for this right off the bat? So if we bought 3,000 preferred shares at 124, our cash will be 372,000. So cash, 372,000. Now, that's the credit side. And you've heard me say in class many times, if you're struggling with an entry, do a part of it. And a lot of times, cash is the easiest part to do. So there's our credit. But what's going to be our debit? We've got 3 parts of the debit that we need to do here. Well, just like before in our previous entry, what did we issue the preferred shares at? Well, we issued the preferred shares at $110. So 3,000 times 110 is 330,000. So we need to reduce our preferred shares by 330,000. Now, we're still off on the debit side here. Now remember, we're paying more this time than we issued the price of the preferred shares initially. We're paying $124 when initially we issued the preferred shares at $110. So we're paying more now. So what happens when you pay more? Well, you've got to go through 2 steps. First, is there any contributed surplus related to preferred shares from previous transactions? And if there is, you have to use that contributed surplus up first. Well, we know from transaction number 2 that there is. There's 30,000 related from previous transactions. So we need to remove that first. So contributed surplus, stock options, which was based, not stock options, oops, sorry. I'm on to the previous question. Contributed surplus, preferred shares. We need to remove that 30,000. So we have to attribute the 30,000 that we put in here and now take that account down to 0. But we're still left with values missing here. We're still missing 12,000 on the debit side. Well, when you pay more than what you issued it for, we take it out of retained earnings. And retained earnings will be the final part of this entry. You will debit your retained earnings, and now you will have basically an entry that balances. Let's move on to the second part of the question. Second part of the question deals with the common shares. So when we take a look now at the common shares, we've got very similar transactions as we just looked at in the preferred shares. So we've got a couple selling of the common shares. So the first transaction we see here, which is transaction number 4, is the selling of 2,200 common shares at $115 per share. So that'll be cash, $253,000, and common shares, $253,000. The next transaction talks about how we sold 1,200 common shares at $120 a share. That'll be equal to cash, $144,000, and common shares, $144,000. So what you can see here is that we've sold some common shares, we had some opening balance related to our common shares, and now in our final entry, we've got to do a little bit of work. We repurchased for cash and canceled 500 common shares. So let's get started with the easiest part of the entry. 500 common shares repurchased at $130 a share equals $65,000. So cash, $65,000. Now, what do we have to do? Well, we have a number of transactions that have occurred. We have some selling of our common shares. What we have to do is we have to figure out what is the average issue price of our common shares so far. And we need to incorporate our opening balance. So we need to create a schedule for ourselves. So our common share schedule will be the following. We're going to have a balance, and we're going to have the number of shares. So our opening balance was $399,950. Now we're told that the average price of those shares was $95, the average issue price. So $399,950 divided by $95 equals 4,210 shares that we basically issued. Now what we have to do is take into consideration the next two transactions that we looked at. We have to take a look at that we issued 253,000 worth of shares, and we issued 2,200. We have to take a look at that we issued 144,000 worth of common shares, and that was 1,200. And take the total. 796, 950, and 7610. Once we have this information, we can figure out our average price. So 796, 950 over 7610 equals 104.7240. And as I say in class many times, always go to 4 decimals in calculations like this. Now that we have this, we can complete this entry. We now can complete this entry. So the first thing to take a look at is that we retired 500 common shares. And 500 times our average price of 104.7240 equals 52,362. So that is the retirement of our common shares at the average issue price, the opening balance and the two transactions. Now, we have an opening balance in our contributed surplus. So our contributed surplus, and because that was related to common shares, we have to use that first, just like we did in the preferred shares. And if there's anything missing on the debit side, and there is in this case, we need to attribute it to retained earnings. 5638. And now your question is complete, and I hope to see a lot of 100% answers on your next quiz or your final exam. Thank you.